Welcome back. We are back with Lorne Steinberg. He's, of course, is with Lorne Steinberg Wealth Management, this time to talk about opportunities he sees in the tech sector. You're looking at the NASDAQ Composite Index, up 29% over the past 52 weeks, and that comes after a couple of steep declines that we've seen very, very recently. Not so long ago, the NASDAQ Composite was up 35% on a year-to-date basis. And Lorne, a lot of that, of course, has had to do with those stocks that we talk about over and over again, the so-called Magnificent Seven. We get a lot of calls, as you can imagine, on Market Call. You're with us on Market Call regularly. Investors calling in, is it too late to buy NVIDIA? Is it too late to buy other big high-flying tech stocks? You think there are some other names here, secondary names maybe, where there is value in line with our earlier conversation.
Totally. And one stock that should be in the Magnificent Seven, but which has suffered over the last year, is Adobe. Adobe is... Their earnings act like the Magnificent Seven, and so do their revenues. The revenues are growing at double-digit levels. So are earnings and free cash flow. 25 cents of every dollar is free excess cash flow, which they're using to buy back shares and make acquisitions and grow their business. Listen, they're a cutting-edge business with phenomenal growth, trading at 21 times earnings, which is far, far cheaper than all of the other Magnificent Seven, yet having the same type of metrics as a lot of those stocks.
How do we explain the dismal market performance? What is the market? Why is the market ignoring this stock?
A couple of things. One is they tried to buy Figma, which was a $20 billion acquisition earlier in the year, and the stock fell when that. First, the stock fell when they announced they were going to buy it, and then the stock fell when it was turned down for antitrust. So it was kind of yin and yang.
Yeah.
What do I have to do to make this thing go up?
Yeah.
Then their earnings marginally disappointed, but the reason for that. They're spending money on AI, and they're already incorporating AI into a slew of their product line. But is one of those revenues slightly below expectations and guidance slightly below expectations, and multiple points got shaved off the stock. But it's compellingly cheap with a ton of free cash flow, and it simply means they're going to be able to buy back more stock.
It meets the threshold. In other words, it meets the things that you want to see in a stock that you told us about in our first conversation. Lots of free cash flow being used in the right ways.
Exactly. Great capital allocator over many years.
Okay, Cisco Systems is another one you like.
Cisco is a slower growth company, basically a no-growth company for a number of years, but they've morphed their business into recurring revenues and services. They remain a leader in switches and all other stuff for telecom companies, as well as developing a huge cyber business. And Cisco is trading at 15 times earnings. They've used free cash flow for years to buy back huge amounts of stock, and you're getting a serious dividend at the same time, around 3% or so, and an incredibly well-run business, but growth has started to accelerate again. That's the Cisco story. Okay,
OpenText is a Canadian company. It has suffered as well. Now, the knock that I've heard on OpenText is that it has not done well on M&A, that it has stumbled on acquisitions.
Management has absolutely made some mistakes, and here we are today, as we say. The company's basically stopping its acquisition strategy and focused on integrating these acquisitions across the board. They are well into AI. They're truly a Canadian AI story, but they're now focused on organic growth. The free cash flow yield is now 8 to 9%. And since they're not going to make acquisitions, we're expecting this company to spend a lot of money on share buybacks, which should provide a huge boost to the stock over time.
Has management signaled that use of free cash flow buybacks?
Well, our understanding is that debt is coming down. They have a 3.8% dividend. They don't have to raise it very much. And so our expectation is management's going to shift gears in that direction as they're focused on organic growth.
So your view is the market eventually will recognize the financials in these stocks?
And also, OpenText is trading, call it 8 times earnings. This is a high-quality technology company. Should be double that.
Has management has signaled that the M&A strategy is on pause, have they?
They've certainly signaled that it's not going to be a core focus going forward, that they're focused on organic growth.